Hello, good day everybody. I'm Ranu De Silva. Today I have with me Ruan Pereira, who is the president of the Unit Trust Association. Ruan counts for over a decade in the industry. So today I've asked him to come join us so that we can get a big overview of the industry as well as to understand how we can get it join onto the unit trust market there. Good day, Ruan.
Good day.
Ruan, just to get right to it, can you give me a little introduction to the unit trust in a more layman terms? I would say, our viewers are more home set. So, Ruan, what is your how would you classify or how do you introduce unit trust to us?
Well, there's this perception when it comes to unit trust. Everyone thinks it's share market investments, which is not the case. Unit trust definition per se is a bold investment scheme, and when it comes to products for normal person, you have a whole range of products from money market accounts, which is very much similar to the savings account, normal savings account. Then you have bond funds, and then you have share market funds, which invest in share markets. So basically, what happens is when say we want to invest, we have $10,000 or $100,000.
Yeah.
We want to go and invest in a bank, for example, bank deposit.
Yes.
And you will go to a bank, you ask for, say, I have 100,000, I want to invest. They will say, okay, 1 year FD rate is 12%, and you take that. That is called the rack rate.
Right.
You'll get it.
Yeah.
But if you have 10 million rupees, you might be able to negotiate more than that.
Right.
So what happens is, you have many investors with 100,000 or 10,000 bucks. Say 1,000 investors or 10,000 investors is $1,000. Then you pool that money, and then you go to investors. Based on the fund's investment objective, whether it's a money market or whether it's a bond or a share market, you will go and invest in that particular instrument. It could be a bank deposit where you can negotiate higher returns.
Right.
That is the basic level.
Okay. So what we are saying, Ruan, here is like when you're a bigger fund, when you pool in the funds, that you have a bigger bargaining power,
exactly.
including the banks as well, because generally you wouldn't as an individual.
Exactly.
Right? Okay.
Exactly. Apart from that, what you get is you are able to get the professional services of a fund manager. Okay. When you go to a bank, if we are to invest or save, we have only few options available. One is the savings account, and then you have the fixed deposits.
Right.
When we'll take those two examples, what would be? I will ask you a question.
Yeah.
What is you have? I'm sure you have a savings account.
Yes, of course. Yeah.
Okay. What is the interest rate of your savings account?
Yeah, I am with one of the state banks, Ruan. So I think I'm getting about 4% on my savings on annual basis.
Okay,
yeah.
I think you are one of the savvy guys who might be knowing it. But actually, on average, the average savings rate, a normal savings account, is about 3.5%.
Yeah.
But if you take a money market fund, a unit trust fund, which has we have about 10 to 12 in the industry. You take average money market fund, it would give about a 10% return, which is about 6% more than a savings account, and accumulate that over a 10-year period. That is very significant. And if you take for example, a kid's savings account, you might be getting about 5
to 6% generally. Yeah.
But just accumulate that. If you can invest in a 10% over a longer period, because until 18 years you can take.
Yes.
Okay, I can give you a classic example of my personal company.
Yes.
Our company was launched in 20 years ago,
right,
in 1997. When they launched, of course, it was a share market fund.
Yes.
There was a share market fund which is called a growth fund,
right,
or the balance fund. A grandmother had come and invested $5,000 on behalf of her granddaughter. And 2 years ago, she came with this 5,000 rupees, the confirmation. She came and asked, my grandmother has invested $5,000. I want to withdraw this. Okay. She got 300,000 rupees.
Wow.
That has grown
Yeah.
over a 20-year period to 300,000.
Wow. Okay.
And she took that because she was going to the university. She wanted money.
Yeah.
So I mean, she was a lucky person.
I think she's got more than she
I think,
expected.
I think grandmother has made a prudent investment, whether knowingly or unknowingly.
Yeah.
She had made that investment.
Right.
So I think that 1% or 2% extra over a long period, when you call the interest on interest,
Yes.
is going to be a major. I mean, that will make you a rich person or
yeah.
normal
Basically,
person.
right.
So I mean, that is it. Then apart from this normal savings account, you take the FDs.
Right.
When you go to a bank, you take the best return.
Yes.
You don't know whether it's 3 months, 12 months,
Yes.
6 months, 5 years, or 2 years. Whether you check on the rate, and depending on the rate, you will put money into that fixed deposit. You don't consider whether you need that money in 3 months' time. You need it in 6 months' time. So that is where this professional fund management comes in.
Right.
When we invest, we try to discuss with you what is your liquidity requirements, whether you need money immediately, whether you need money in 1 year's time, and plan accordingly. And then I can advise you to invest in various funds.
Right.
If it's a long-term thing, then if you can take a little bit of risks, then we might recommend a bond fund or a share market fund.
Okay.
Or else we might recommend a money market fund or an income fund. Okay. So likewise, depending on the client's requirement, we can advise. So at the unit trust, you have a range of investments.
So Ruan, again, let's say I assumed it was a guy who or an individual who will come with a bit of a lump sum to invest. But let's talk about young guys like us, maybe working. If I want to have a regular investment, is that option also available?
Yes,
within the,
yes, you can invest anytime. You can withdraw anytime.
Right.
I think one of the biggest problem as a nation, or I mean, at this moment, I think globally is the problem, is the aging and the retirement.
Yes.
So what we can promote is, okay, you can start, instead of putting a lump sum, you can set aside, like, I mean, we all contribute to EPF if you are a private employee.
Yes.
So like that, you can set aside, say, $1,000 or $10,000 or some amount, and you can give a standing instruction to any of these funds depending on your requirement. And over a period, you can structure a retirement plan, retirement income or retirement savings. So of course, over a period, you can structure retirement savings for young guys like you, retirement saving. And once you retire, you can have the retirement income, the money that you have saved, you can structure retirement income plan.
Okay. So Ruan, and also we are also very concerned about the risk factors that we might be taking on going in for such an investment. I think with my knowledge, I think there's a huge misconception that it only revolves around very risky investments, is what the perception in the market. But can you just highlight a little bit about what are the risks that we might be facing as a individual investor?
It's like this. Now, it depends on the fund because each of the unit trust fund, there are restrictions when it is set up.
Yes.
There are objectives. So there are restrictions which it can invest. It can be, say, a particular fund can invest. If it says it's a money market fund, it can only invest up in instruments, say fixed deposits or government securities or anything which has only maturity of 1 year.
Right.
If it is a bond fund, you can invest in any tenors, or there can be restrictions in the tenors also. But if it's a bond fund, it's a government securities bond fund, that means it can only invest in government treasury bonds and treasury bills.
Okay.
If it's a income fund, it can go into fixed deposits, securitized paper, commercial paper. And of course, I think there's a great opportunity for individuals. There are corporates who borrow from the market in the capital market, which pays a good rate than the bank FD, but which is not accessible for normal individuals. So, but it can be accessed through unit trust, because the unit trust managers, when they invest, before they do a credit analysis of the corporate which they give money. So that is where I think I could explain that before. The unit trust, the professionalism, that is where it helps you, because it will help the fund the fund managers what they will do is they try to maximize the return while minimizing the risk, and doing so they will try to, when they invest money wherever, even if it's a bank, they will do a credit analysis and do a evaluation, which you can't do. And the beauty of it is that the fund will be in a diversified portfolio. You can't, each fund can't invest in more than 15% in single entity. So if you take a bank, say there are two banks. If I have money, I will go and put it in a particular bank. So, and I am exposed to that bank. So, but if you take the fund, unit trust, they can invest only 15% in a particular. So they will have a diversified pool. They'll at least need to invest in 6 institutions. If it's a fixed income fund.
So like what you're saying, Ron, sorry.
So you'll get a diversified pool.
Yes. So that means, like these bonds and certain products in the market, or, instruments in the market, where individuals we are not able to, or they have the capacity, we can have part of that business now. We can have part of that return when we go through a unit trust. So that brings a big advantage to a small, a small as well investor who's starting out, or households as well, I believe.
Yeah, exactly. And each 1% is additional income for you. You can spend.
Yes.
Another thing is when we invest, we will invest. I was explaining it. We also fixed deposit. We will lock it in for 1 year period. For example, if you take a 1 year FD, you might lock it in at 12% now, most easily. But down the line, 3 months time, it goes to 14%. Or it can go down to 10%. You don't know. But as fund managers, we will do analysis. The fund managers will do each fund. The fund manager will do analysis, and they will do research, and they will forecast whether the interest rates, market rates might go down or go up. Depending on that, they will invest in the funds. The funds will be invested, so the returns to the investor will be maximized.
So, Rohan, we spoke about in terms of the money market funds where you invested in short-term funds in terms of instruments, about a 10% return. But Rohan, have we seen returns on average? Let's take the last 5 years or so. How have we seen the returns on these products or the different products? Can you give me a few examples?
Well, over the last 5 years, I think money market funds, it was started about 4-5 years ago. It was popularized mostly. It easily gave about 5 to 6% above the savings rate. And at certain points, about 2 years back, it even gave a better return than a fixed deposit. So about 2 to 3%. So which was very attractive. So then I think a lot of corporates, coupled with there's a tax benefit for the corporates. They invested in these funds, and individuals also started to invest. So I think over the last 5 years, they have done pretty well.
Rohan, in terms of just to round up things, to our viewers today, if somebody's coming freshly on the market, what is your advice as the President of the Unit Trust Association? What's your advice to new investors when they're coming in? How do they select a partner to go with? I mean, what are the criteria they should be looking at?
Well, they should look at the convenience fund, the returns of the funds, and how quickly they can get money, and the service. So I think we have a lot of companies now, 14 companies, and there are 74 funds, mutual funds. Sri Lanka, of course, all over the world there are places like India, USA, Malaysia, very popular. But Sri Lanka, it hasn't been popular because people are more convenient with they are used to banks. And but obviously I think it's getting catched up. I mean, people are catching up with the concept. And because it's slightly a sophisticated concept. So, but of course, that's my advice. You can start with the money market account, and then experience yourself. Then gradually, with your experience, you can see, depending on your risk appetite, we can graduate from a bond fund or a equity fund. So that can be done with the help of the advisor.
Lovely. Thank you so much, Ruan, for joining us today. Thank you very much for all the information. I think we had a very good roundup. I think very interested in going out there and looking at the unit trust myself. Thank you, everybody at home. Thank you very much. Have a very good day and all the best for the season. Bye-bye.